Welcome to the EIU's monthly global forecast discussion. I'm Alex White, Country Analysis Director. We're going to be talking about commodity prices today, and I'm joined by Sebastian Marlier, who's our commodities expert, commodities analyst here at the EIU. So, Sebastian, let's start with oil. Brent's remained below 50 throughout August and September, despite some demand pressures. Why?
Well, it's true that oil demand has been rising relatively fast this year. In fact, at its fastest pace in 5 years. And that's because motorists in developed countries have responded enthusiastically to the fall in prices since the middle of last year. It's also because we've had a colder winter than in 2014 in the northern hemisphere. But you have to set that against very, very robust supply in several regions. So Saudi Arabia and Russia, the biggest producers, have continued to expand supply. The same can be said about Iraq, which in July 2015 was producing an additional 1 million barrels every day compared with July 2014. And in addition, you've had bearish sentiment on oil, because in July you also had this announcement about a nuclear deal on Iran with Iran and the P5+1, and weakness in China's economy has created concerns about China's demand for oil. So all this has added to bearish sentiment and kept the prices low throughout the summer.
Okay, so what about the outlook? How do we see things going forward?
In terms of the outlook, our view is that we're not going back to $100 a barrel anytime soon. In fact, we recently revised our oil price forecast for 2016. We now see oil prices rising to only $60 next year from about $53 this year. And there are a number of reasons for this. On the demand side, what we see is demand growth slowing again next year, because the price and weather related factors will abate. And in addition, we're having slower growth in a number of emerging markets, which will dampen demand. And against that, again, supply will remain quite strong. Supply is falling in the US, where shale producers are struggling with lower oil prices. But this will be offset by rising production from Iran when sanctions in response to the nuclear deal will be removed. And it will also be offset by strong production in the rest of OPEC and in some other countries. So overall, the market is tightening a little bit, but not sufficiently to push prices back up very quickly. And that's why we're seeing prices increasing very gradually next year.
So some analysts have suggested that sustained low prices will have a chilling effect on investment, that you get the bounce back, spike in prices again in a few years' time as a result of it. We've seen Shell pulling out of its Arctic project, for example. What do you think about that?
Well, it's complicated. It's true that you have a number of projects that are being shelved or delayed. And the most recent number I've heard is about $200 billion worth of investment in oil and gas that has been shelved. But the Arctic, for instance, this kind of project was not going to come on stream until at least a decade. So bearing this in mind, and bearing in mind that we're having additional supply coming on stream from cheaper regions like Iraq, where there is some investment going on and where we see output increase towards the end of the decade, like perhaps Libya, if the situation stabilizes towards the end of the decade. So there are still a number of regions where supply is growing. And I would also add that the supply of US shale has really transformed the dynamics in the markets, and US shale producers can respond much faster than we used to be able to a positive signal from prices. So that will keep a lid on price growth in the medium term as well.
Let's talk about some of the other commodities now. It's been a tough few years. What's the outlook?
So for the other commodities, the story has been awful this year. After sliding for 4 years, prices really fell off a cliff this year. And it's true for agricultural commodities or industrial materials. But for next year, the story is looking a bit different. A modest rise in commodity prices is possible. And this will be driven first by slightly higher oil prices. As you know, the oil price feeds into the production price and the transportation costs of a number of commodities. In addition, we're seeing a slight rebound in investment in the construction sector in China, which will support demand from that part of the world. And for agricultural commodities, there is a very strong supply story there. One reason for the weakness in prices over the past few years was record harvests for a number of agricultural commodities, especially in the grains complex. Well, these record harvests won't be repeated this year, and so we'll have slightly lower supply. And then you have to add the risk of El Nino for a number of other commodities, which could, again, lower the output next year and put upward pressure on prices. So overall, we expect modest increase in prices of most agricultural and industrial commodities next year.
Can we turn to China and some of the potential impacts of a Chinese hard landing? That's not what we're predicting in EIU, but obviously there's concern that as the Chinese economy slows, that's going to have some real impacts on commodities across the board. What's your take on that?
Well, it's true that China's demand for a number of commodities has been weakening, and that's been part of the whole story and the concern. And we are concerned about what's going on in China. We're seeing industrial production halving. We've seen industrial production halve between 2010 and now. We've seen exports stumbling, which has been a driver of China's growth over the past few years. This is now coming to a halt. And then we've had these poor policy decisions over the summer on stocks prices and on the currency. But at the same time, we remain of the view that China will avoid a hard landing. Yeah. And that's because the services sector in China is now a bigger part of the economy than the industrial sector. And the services sector is in fact doing quite well. It's growing at a strong pace this year. In addition, we've had some good news recently from the housing market, where prices, especially in the big cities, are rising again. And another good news is that wages are still rising at a healthy clip. That means that consumption will be supported by higher incomes, and that's exactly what you need in an economy like China that's moving from an investment-led model to a consumption-driven model.
What about other emerging markets? We've talked about weak commodity prices, we've talked about a slowing China. Where does that leave the big commodity producers in emerging markets?
I would say that, that emerging markets in general are in a difficult position now. They face headwinds from China's weakening demand, from the lower commodity prices, but also from the looming interest rate rise in the US. So that's really a problem. And we expect growth in many emerging markets to slow. Brazil and Russia are the biggest examples where we expect a second consecutive contraction in those economies. And that's partly a commodity story, partly also because of policies and politics in those countries. But in general, the picture in emerging markets will be difficult. We expect volatility, we expect downward pressure on the currencies. And because of these cutbacks in investment in the commodities sector, there will also be reduced economic activity, reduced investment, reduced job creation, and overall weaker economic growth. But that said, we don't expect a full-blown crisis in emerging markets like the one that we saw in 1997, 1998 in Asia, for instance. And that's because the fundamentals in a number of emerging markets have become stronger. Just for an illustration, the amount of foreign exchange reserves in non-OECD countries stood at over $9 trillion at the end of 2014, compared with about $1 trillion in 1997, 1998. So we have stronger fundamentals. We also have fewer economies operating pegged exchange rates. We have local bonds markets that have been developed in those countries, which means that debt repayments won't become more expensive when the US dollar appreciates. So overall, we think that most countries will suffer and will have a period of lower growth, but that they won't fall into a deep crisis like we've seen at the end of the past century.
Thanks very much indeed, Sebastian. So, interesting outlook ahead of us. Weak markets for commodities, but we're seeing improvements slowly and steadily from next year. It looks as though, from an EM perspective, the Fed hiking cycle is as much or a bigger threat than commodity prices. Situation should be manageable overall. Watch this space.